If you bought Bitcoin at the beginning of 2016 and you held it until today, you would have achieved a Sharpe ratio of about 1.2. If you were traded Bitcoin in and out during that time, you may have achieved higher risk-adjusted returns, but the big question is, when do you buy and when do you sell? In the algorithm I want to show you today, I use this Python library called mlfinlab. This library implements trend scanning, which is a labeling technique to determine if the market is currently in an uptrend, no trend, or downtrend regime. This labeling technique was introduced by Marcus Lopez de Prado, and you can learn more about it in his book here. But here's the code of the algorithm. It's just looking at the last 3 months of the price curve for the Bitcoin-USD pair, and it feeds in those historical prices into this trend scanning labels function, which will tell us if it's in an uptrend, no trend, or downtrend. When the algorithm finds that Bitcoin is in an uptrend, it allocates all of the portfolio to Bitcoin. Otherwise, it just holds US dollars. And here are the results of the algorithm. If I scroll down, we can see that this algorithm achieved a Sharpe ratio of about 1.8 instead of just 1.2. In cases like these, I like to perform further tests just to ensure that 3-month look-back window isn't just a lucky number. And in fact, in this algorithm, you can use any look-back window length of 1 month to 12 months, and you outperform just the buy and hold Sharpe ratio of 1.2. So I'll leave a link to this strategy code in the description below so you can run it yourself, and let me know what you think.